Welcome to our YouTube Live, and the goal here is to summarise what the Federal Reserve has just said about their monetary policy, and I'll try to keep it brief and punchy, and then you can ask questions at the end of it. So let's just start off with a kind of broad brush story. I think the main point is that it's pretty clear that the Fed is now almost at the point where they think monetary policy is tight enough. I think there are kind of two modes that Powell talked about, and the first one is that are we in a tight enough monetary policy point yet? That's the point that they think they're at right now. They think that there could still be another hike to come this year, for example. And then once we've had that decision that is kind of tight enough, then the question is how long are we going to stay here? Because even then, the Fed's probably going to keep it at that tight level for a long period of time. But for this meeting, they kept their policy rate unchanged. So, there's not been any policy change as many people expected. That was the market expectation. In fact, this whole rate hiking cycle, there's been very little deviation from what markets expected. Whether that's deliberate or not, or whether markets just guessed it right, who knows? But it's certainly the case that it's been consistent so far. Further out, there's been a big move in expectations, but we'll talk about that in a sec. The thing which Powell said repeatedly was that they now have the ability to move carefully now that they've come so far. With a more than 5 percentage point increase in interest rates, they think that they've got a bit of leeway now to take their time and look at the data as it comes in, and they're not firefighting inflation anymore. They're just seeing, they're waiting to see whether inflation comes down substantially and whether they can start to think about an exit point. But at this point, still looking at whether monetary policy is restrictive enough, and they don't seem to think they're quite there yet. There are some interesting points on the dot plot, because this was a dot plot meeting where they come up with a summary of economic projections, so we can see what the members think is going to happen to various economic variables going forward. And again, we'll see some interesting points there as well. But, there was also the point that we are seeing more slack in the labour market, and the path to a soft landing is looking more likely. So let's have a quick look at where we are and what happened in terms of expectations, but also in terms of their decision. So let's start off with expectations. So I'll move myself down a bit. There we go. So what I usually do is I show where the probabilities are for expectations, and this is based on the FOMC FedWatch tool, which is available from the CME. And what I've done is I've taken snapshots through time to show what the probabilities were at for the policy rate at various points in time. So if we go back all the way to February of this year, you can see that people were expecting that this hiking cycle would peak at between 475 and 500 basis points, 4.75 to 5%. It would stay there for a while, and then the first cut would come November of this year. But then as we moved through time, what we saw was actually, no, markets realised that the Fed would peak at a higher level, which it has. This is currently where we are now, between 5 and 5.25%. But it thought it would just stay there for 2 policy meetings, and then it would start to cut very aggressively, which I thought was unrealistic. Then the aggressiveness of the cuts became even more marked in the May meeting. Then we thought that actually, no, it's going to peak at between 5.25% and 5.5%, stay there for 3 meetings and get aggressive cuts. But gradually what's happened through time is the first cuts moved further out in time. So March 2024, June 2024, is the latest. So this was as it was this morning. And now what we're expecting is today's meeting was spot on, 99% probability of keeping rates constant, that the current policy rate of between 5.25% and 5.5%, and the market's now expected it'll stay there until the beginning of next year, and the first cut's going to come in June of 2024. So a big change in time of expectations of, what people have backed out of the Fed funds futures market. If we look at the language of the FOMC statement, you can see how it's changed since the previous meeting. Now what we're talking about is maintaining rates, of course, because we're maintaining it between 5.25% and 5.5%. They're going to carry on cutting the size of the balance sheet. We'll see that in a moment. And otherwise, no huge changes. Economic activity has been expanding at a solid pace rather than moderate pace. One of the points that Powell made was that economic activities remained well above most people's expectations. And the other point is that job gains have remained strong, although they have slowed in recent months. And we'll see that when we look at non-farm payrolls, for example. But of course, inflation remains elevated. I thought this comment was a bit unfair. This is a tweet that just came out from Mohammed El-Arian. And what he says is that he thinks that the economic and policy signals coming out of this press conference that we just had came across as confused and confusing. I think that's completely wrong. I think that it's been very consistent, the policy communication through this entire hiking cycle. So I'm not sure what he's referring to there. Of course, it's a transition point when we go from hiking to kind of keeping rates constant and high. But that's been the narrative that we've had all along. We've had for several meetings now, Powell was talking about keeping rates at a high level once they found the level they're happy to be at, and they still weren't there yet. This is what he said repeatedly, and he said it again today. So I'm not sure what he means by Fed communication being bad. Maybe it's because he wants a job. I'm not sure, but it certainly, I think, is unfair. Now, another point which is really important is the colour of Jerome Powell's tie, which I think is really important. So if we look at the last meeting, you can see he went for this purple number, and that maybe is his kind of dovish tie, because that was the first point when he stopped raising interest rates in this cycle. Today, again, he's gone with the purple dovish colour. Now, I am colourblind, so I'm just going to have to assume that those are the colours, but it looks purple to me, and I think that could mean dovish, but I haven't done a full analysis. It could be flawed. So now let's move on to the summary of economic projections, because this is a meeting where it's been updated. They're not updated at every meeting. And let's have a look at what they've actually done this time. So this is as it was. So these are the dot plots, which many people pay attention to. Each of these dots, so that was the previous meeting, and this is this meeting. Each of these dots is one member of the FOMC. There are 19 members, 19 voting members. It's their forecast of where the policy rate will be at the end of this year, next year, the year after, 2026, and for the longer run. And what was interesting was that this year didn't change. However, half of the members, well, slightly more than half, 13 members, I think, expected that there'd be one more rate hike over the course of this year. We've got 2 more meetings to go. So one more hike. Whereas 1, 2, 3, 4, 5, 6, 7, so it goes 7, 12, sorry. 7 people thought that there wouldn't be another hike. So there was a split, but the vote was unanimous to keep it constant for this meeting, certainly. And if we actually look at the FOMC Summary of Economic Projections. So this is the actual document itself. What was interesting was the changes, particularly if you look at the policy path. So if you look at the Fed funds rate as it was projected at the previous Summary of Economic Projections, you can see that for this year the median hasn't changed, 5.6% for the end of this year. But if you look at 24 and 25, there's a big shift upwards. So 50 basis points or 0.5% upward move in the median projected Fed funds rate from 4.6 at the end of 24 to 5.1. And for 2025, another 0.5% increase. The longer run hasn't changed. And last time we didn't have a forecast for 2026. So that's a pretty big change. So in other words, it's a kind of hawkish signal that the Fed does think that the current rate is not sufficiently tight, and that we will see more. Certainly, it'll stay higher for longer than people expect. And of course, this is on the way down, right? So it'll peak at 5.6 according to this, and then in 24 it'll come down slightly, but more slowly than people expected, which is hawkish. So that was a change. The other thing which changed was the forecast for growth, which surprisingly was better than people expected. So soft landing, in other words. Previously, they only thought that GDP would be 1.1% in 24. Now that's moved up by 40 basis points to 1.5. And in 2025, it hasn't changed. So stronger growth than expected for this year and next, and then down to 1.8, which is the long run GDP growth rate. So unemployment also revised downwards because the labour market is stronger than expected. So that's the kind of summary of economic projections for what it's worth. And of course, they're always downplaying that because Powell says, oh, it's not really a forecast, it's just what members of the policy committee think. But it's really important because it gives you an insight into their thought processes and what's driving their decision. If only we had that in the UK. So, hopefully the Bank of England will one day produce a summary of economic projections. And by the way, tomorrow I'm doing this for the Bank of England. So 2 policy meeting live streams in 2 successive days. So let's look at the labour market now, because of course the tightness of the labour market tells you whether that's an inflationary jobs market or not. And the US labour market was very, very tight indeed. Now, one of Powell's preferred measures of tightness is the number of unfilled job vacancies per unemployed person. And it peaked at around 2. So there were 2 jobs available for every unemployed US citizen who was eligible for work. That's come down very considerably. And you can see that the rate of falling is quite significant. So that has started to accelerate downwards by the look of it. Now we've got 1.4 jobs available for every unemployed person. So still tight, but less tight. It is getting a more slack labour market. That's what they were hoping for. And if you look at the CPI inflation, it's ticked up slightly for headline inflation, but not significantly. And that was due to energy prices increasing. If we zoom in on that unfilled job vacancies per unemployed person, I always show this just to show that when there's a recession in the United States, those are the grey bars that you can see here. That's what really makes the labour market. It generates more slack in the labour market because more people are laid off. And it really doesn't look like we've got a recession in the United States in the offing. However, this thing is falling pretty quickly without a recession by the look of it. Maybe we are seeing the beginnings of a recession. If you look at the SARM rule, which is Claudia Sarm's recession indicator, real-time recession indicator, that is starting to tick upwards as unemployment ticks up a bit. but not a lot yet. It often moves quite quickly when it does start to zoom upwards, but maybe we will see higher unemployment, but certainly we're seeing more slack in the labour market, which for the Fed is good news because unemployment hasn't increased too much, and yet we are seeing more slack in the labour market, which of course is what they were trying to engineer in the first place. If we look at the non-farm payrolls, this is the number of jobs which are added to the US jobs market month to month. We usually look at the monthly change, so that's in the bottom graph that you can see here, and the top graph shows you the total number of employees, just to show this huge pandemic fall. You can see that currently it is seeming to slow down. The latest print was 187,000. If we zoom in on that to the more recent period, you can see the monthly additions to the labour force. Just to keep the US labour force ticking over and absorbing new entrants to the jobs market, you'd need about 100,000 new jobs added. Currently we're seeing around 187,000. So certainly slower than it was, so that is a sign of slack. There was a big jump downwards 3 months ago, but the latest prints seem to be speeding up again. But still, weaker jobs growth is what the Fed is aiming for, and more slack in the labour market, and bringing supply of workers into sync with the demand for workers. Currently, the demand is outstripping the supply, and that's inflationary. So now let's look to see whether we do have a price-wage spiral. Of course, this is the central bank's worst nightmare. When wages chase prices and prices chase wages. Is there evidence for that? Not really. It's still the case that if you look at earnings growth in the US, the rate of growth is 4.3%. That's the latest print. And if you compare that with pre-pandemic, it was only around 3% or 3.2, maybe even 3.4. So still above the level which you'd expect in normal times, and probably far too high to be consistent with inflation at the 2% target. So I think there's still a lot of work to do here to get earnings growth down. However, the good news is the wage growth is positive in real terms. So that's going to help people, but it does come with a problem, which is that it could make it take longer and require a tighter policy for longer to get the Fed to 2% inflation, which is where they want to be. Now let's look at the balance sheet, because that's one of the other policy tools which the Fed has. And of course, we just had one round of QE after another, which pushed the size of the Fed's balance sheet to $9 trillion as it hoovered up all of these mortgage-backed securities and US treasuries. We are starting to see that fall. Then we had the banking crisis, the regional banking crisis. Silicon Valley Bank and others went bankrupt. The Fed had to give its own balance sheet to those banks to give them loans at a rate of about 4%. And that way, these banks could take out those loans and stop, pay customers as they walked out of the door and avoid bank runs. So the Fed successfully stopped bank runs, but it also increased the size of its balance sheet significantly. However, it has started to shrink again once that crisis subsided. This may happen again now because the commercial real estate market in America is running into problems, and a lot of those regional banks have a lot of commercial real estate loans, so there could be another deterioration of their balance sheets due to this commercial real estate problem. But certainly for the time being, that hasn't happened, and we're now looking at a shrinkage in total of about 9% from the peak point in the Fed's balance sheet. So this is another monetary policy tool as well as interest rates, and it does show tightening. So the overall, if we zoom out even further, you can see each round of quantitative easing and the effect on the size of the Fed's balance sheet. It went up from 1 trillion to 9 trillion, and of course the pandemic was the source of this huge increase in the size of the balance sheet, the most recent one. And now it's just letting the bonds mature and roll off the balance sheet without reinvesting the capital. That's how it's shrinking. Of course, it's not selling its treasuries because it doesn't want to crash the treasury market. The Bank of England, on the other hand, is actually selling its treasuries very carefully. So now let's look at core inflation, because the flavour of inflation which the Fed looks at is core inflation, not headline. The reason for that is that if you include food and energy, they're very volatile and they don't predict what's going to happen to inflation in the future as well as core inflation does. So if you're looking at the time series for inflation, you want to forecast it in future. Core is a better forecaster of future inflation than headline inflation, which includes food and energy. Energy, of course, is an exogenous factor. It can't be controlled by monetary policy, so it is kind of irrelevant to their policy making, and it's very volatile. And at the moment, what's happened is that gasoline prices, energy prices in general, have gone up again, and this has affected UK inflation less, but certainly for the US, notice how CPI inflation has ticked upwards as a result. Before this happened, you'd found that energy prices were pushing down inflation. Well, for this latest print, they pushed up headline. Now, core inflation isn't affected by energy directly, but that is starting to come down, and it does seem to be steadily falling, which is great news for the Fed, but it's still at a very high level of 4.4%. So that is worrying. It is starting to be affected by monetary policy, but it is taking a very long time. If we look at US CPI components to see what's changing year to year and month to month, you can see the components which are in positive territory year on year are things like transportation services, still positive territory, rental income, so owner's equivalent rent, still rising, and shelter as well. But then some of the components which depend on energy, like gasoline, used cars, fuel oil and other fuels, airline fares, those are falling year on year. But then if we look at the monthly change, which just looks at the most recent month, which is August compared to July, you can see that gasoline did tick upwards again by around 11%. So did fuel oil, so did airline fares. So if this carries on, and remember that there's been a production cut by Saudi Arabia, Russia's probably going to join into that, then that could push up the price of energy and create a secondary spike in inflation for headline. If it remains elevated for a long period of time, one of Powell's points during the policy meeting today was that if it remains high for a long period of time and continues rising, it can become embedded and spread to other components of inflation. So that is the worry. And if energy prices continue to rise, then this is going to be another potential spike in inflation, which is often what's happened in the past. It happened in the 70s that we had a double peak. But that'll be terrible news for the Fed. So let's just hope it'll be terrible news for people as well, because they'd have to weather another shock now that their savings are depleted, which is going to be a problem. This is the inflation measure that the Fed actually looks at, which is personal consumption expenditures inflation. And core PCE here doesn't seem to be moving down so quickly. And the latest print actually increased to 4.2%. Headline obviously is falling, and that also ticked upwards, however. But core PCE is what the Fed actually targets, and it's still twice its target rate of 2%. So it does seem as if inflation is still sticky, and given that this is the Fed's mandate to fix this number, you can see why they're saying that policy will probably have further to go, because core doesn't really seem to be responding as quickly as anyone would have hoped. It's been about over a year that it's been above 4%. So that's very worrying for the Fed. If we break down the components of core inflation, services are still rising year on year because they depend heavily on wages. And as we saw, wage growth in the US still remains elevated. So until wage growth starts to abate, and that'll only happen when labour supply and demand come back into balance, then this will remain elevated. So certainly this component is seeming to be very resistant to monetary policy. Durable goods, however, that inflation was due to supply-demand imbalances and disruptions of the supply chains due to shipping not being able to get through, and the big change in behaviour after the pandemic when people were buying stuff rather than services and not being able, and then shops couldn't supply enough stuff for them to buy, and that pushed up prices. That's very clearly come back into normal rates of growth. And similarly for non-durable goods, those also, inflation there also seems to have come back down. The standard example for durable versus non-durable, durable would be your car and non-durable would be the gasoline that you put into your car. But inflation seems to have abated for both of these. So the one which is really worrying is services, which is of course still elevated and dependent on wages. If we look at expectations for inflation based on markets, this is the 5-year rate of inflation, 5 years in the future, backed out of the inflation swap market. And you can see that this is fairly well anchored close to the Fed's 2% target. It is creeping upwards again, so that is worrying, but it's still not too far above the Fed's target of 2%. It's at around 2.4, just over 2.4%. So the Fed's watching that probably quite carefully, and also survey-based expectation measures for inflation. So if energy, for example, does start to creep up and carries on rising, you know, we're talking about $100 a barrel for crude and beyond, then potentially this could start to creep higher, and so could inflation itself. So that is a worry. But certainly for the time being, it seems like inflation expectations are anchored, and that means that the Fed is credible, which is very important for their monetary policy. So now let's look at the last point, which is always a bit controversial, because Powell often says, oh, conditions are getting tighter, they're very tight. But when you actually look at the measure which is produced by the Fed, this is produced by the Chicago Fed, you can see that credit conditions are going down in this graph, which means that they're getting looser, not tighter. And if you look at the components, all three components of that measure, the National Financial Conditions Index, all three components, credit, risk and leverage, are all getting looser. So it's not the case that monetary policy is feeding into this measure any of its components. So markets are behaving as if credit conditions are looser. So not consistent with what Powell's saying again, but still maybe he looks at different measures. Of course, the monetary policy rate is getting tighter, it's stayed tight, but by these measures, it doesn't seem to be affecting markets as if it were tight. Right, so let's have a quick break while I have another drink, where you ask questions and I summon my dog to have a treat. Unfortunately, I've only got the low-grade treats. I haven't got biltong. So Laura's got the good stuff downstairs, and I've only got the second-rate healthy dog treats. Let's see if I can summon him. Ted! This will give you a chance to ask a question. So please do ask a question. If you do a super chat, we'll push you to the front of the queue. And if you're one of our supporters on YouTube, also we'll push you to the front of the queue. Oh, here he is. Interested in a treat, old chap? Yes. Good boy. Very good. I gave him lots today. I was worried he wouldn't eat them. But I had a power hour with one of our customers, and he just didn't stop asking for them. So, oh, here we go. You like the healthy ones now? You like it? Good boy. Brilliant. So what do you think, Ted? What did you think? Purple tie? Does that mean hawkish or dovish? probably dovish. Okay, so let's go back to your questions and let's see what we've got. So Laura produces a document so I can see what your questions are. Laura's asking if I need a drink because I was coughing at the beginning of the it was actually the drink that made me choke. That's why I was choking at the beginning. And Slack is on and I couldn't work out how to switch it off, unfortunately. Control W apparently is supposed to shut it down, but for some reason it didn't. Maybe it did eventually. No, it didn't. Okay. So Leonard von Nebelschutz, thank you for joining us again. Nice to see you. He says, thanks for all the work, Ramin. BR to Laura and Teddy. Best regards, I guess, to Laura and Teddy. Thank you, Leonard. Cheers. Nice to see you again. I like your icon. It looks very cool with the shades. Super chat from Matthew Dick, who says, thank you for that, Matthew. He says, given we're potentially looking at interest rates higher for longer, is Lixor Smart Cash C, Sterling, UCITS still a good bet? I've just bought some more of it myself, actually, Matthew. Let's have a quick look at the UK yield curve because it's kind of interesting. It's still pretty chunky, the yields at the short end of the curve, and there are very few signs that the UK curve, at least, is moving downwards. I'll just share this 1 second. Here we go. So this is one of the trackers you get as a member of our community, and let's look at UK gilt yields. This is a time series. So if we look at the stuff since 2020, if we just zoom in on that, you can see that currently it has come down a little bit, but it's still at the 5-year point, it's at 4.3, and the, let's zoom in a bit more so I can separate the two. Yeah, the 5-year is 4.4, the 10-year is 4.4, and the 20-year is 4.5. So pretty flat yield curve in the UK, flat and high. And I'd expect there to be more issuance of UK debt than is probably digestible by the market. So that would tend to push up yields further. And inflation, of course, here is very sticky. So it's unlikely that that's going to push down yields at the long end. And growth is weak. That's pushing in the opposite direction. So yeah, at the moment, it doesn't seem like yields are moving a lot across the whole curve. It seems to be that they've gone high and they're staying there for now. There is correlation between developed market yields. If we break it down by individual bonds, and this is the entire yield curve for individual UK bonds going out to 50 years, you can see this kind of inverted structure, which is kind of weird, with a kind of kink. I can't do that with my arm. Okay, there's a kink like that. Here's the curve anyway, so you can see that. Let me just zoom in a bit more. Is that better? Yes. Here we go. So that's what the curve looks like. At the short end, you can see those yields are pretty chunky. So particularly, let's zoom in on that bit. So up to 5 years, the yield goes from something like 5.2% at the very short end, which is what money market funds like CSH2 will give you, down to about, what's that? That's 4.3% at the 5-year point. So between 4.3 and 5.2. Currently CSH2 is giving you about 5.2. It'll give you the SONIA rate, that's what it tracks. And currently that's about it's over 5.2 from memory. So any money market fund will give you that at the moment. So that's very attractive, I think. You'd only move to one of these bonds and lock in a rate if you think the rates are going to fall. Once you start to think that could happen, you'd go further out on the curve, maybe lock in a rate for, I don't know, 2 years here. You could lock in 5% today with TY25, or if you go a bit further out, you could lock in 4.7% for 3.4 years, or if you go all the way out to 5 years, you could lock in 4.3. So depending on what you think is going to happen at the short end, personally, I think it's going to stay high for some time because inflation in the UK is not coming down substantially, core inflation in particular. In fact, I just tweeted about that today. Let's see if I can find the tweet. Here's Mohammed, who I disagreed with. Oh yeah, another interesting thing. I looked at the dot plot, and what's interesting is at 2026, can you see that it looks kind of bimodal? You know, you've got two different groups of people. 1, 2, 3, 4, 5, 6. I didn't count it correctly. It's 6 people think that the policy rate will be between 4 and 5%. Maybe because inflation could spike again. And then the rest of the committee members think it's going to be between 2 and just over 3%. So big difference in massive dispersion out at 2026. Of course, that's 3 years out. So fair enough, there's uncertainty. But it does look bimodal. So I wonder if this is a kind of schism within the FOMC. Maybe it's to do with this split for 2023. But if we do look at inflation, let's just go back to that, and it's got my tweet here. I did a thread on inflation today. Core inflation in the UK is 6.2, and it's not really falling much. If we zoom in, you can see the yellow line's core inflation. So is it falling? Yeah, a little bit, but not a lot. And inflation in the UK generally, compared to other countries, it's kind of tightened relative to Germany, Europe, France and the US, but still well above, some European countries and way above an equivalent measure of inflation in the US, which is only 2.5. That's the hiccup measure. So yeah, I think monetary policy is going to be tight here for some time. And if you look at UK food inflation, it's still almost 14%, which is terrible. It's been above 10% for over a year. And for the poorest households, of course, food forms a large percent of their expenditure. So, the idea of people going hungry is suddenly much more real. And that's particularly distressing for people in the UK. In the US, I suspect inflation's come down faster, so the pain point's kind of not as immediate for them. But still, yeah, it looks like inflation's still high, so the monetary policy is going to remain tight for longer. So to answer your question, yeah, I think I'd stick with CSH2. And for members, I recently did an update on the rate of growth of the accumulation money market funds, and all of them are pretty much tracking Sonia. Let's have a look at Sonia. What is it at the moment? Bank of England. God, the website still doesn't work. Apparently you have to delete the cookies. So let's do that. Delete, refresh. I actually emailed their PR department, and this is what they told me to do. So you do that, and then it resets again, and you get the same bug. Anyway, what is it? Yeah, that'd be good. Oh, okay. I love the Bank of England. Okay, delete. Done. I hope someone from the Bank of England's watching this and they're embarrassed, because I'm embarrassed for you. Here we go, Sonia. I think it's about 5 point something. I just hope we don't have to refresh it again. Oh dear, I think we do. Oh no! Sorry. Delete. We'll get there. Oh, this is so bad. Can the Bank of England not afford web developers? They're working on it, apparently. Come on, Sonia, that's all we want. The CSH2. What is the rate? Here we go. Right, so the rate is currently 5.2. Yeah, what I thought. Sorry, that was a waste of your time. So back to your questions. So yeah, Matthew, CSH2 I'd say is still okay. And like I say, one of my bonds recently matured. So in the YouTube live, I actually played This Is Your Life and I told the story of the bond's life. But yeah, it's just matured. So I had to decide what to do with the money. And instead of rolling into another gilt, I kept it in that money market fund because I think rates are going to be higher for longer. And that means the money market fund and Sonia will continue generating pretty good returns rather than buying a single gilt. When I think that inflation's about to be put under control, probably a bit before that, I'll lock in a rate for longer. I'll go further out on the curve. And of course, I'll be opportunistic. So if something makes yields spike, then I'd lock in those rates because that's a rational thing to do. Right, next question is from one of our supporters. Thank you, Alex W, who says, with the dot plots, the FOMC members appear to predict low interest rates, 2.5%. This might be seen as a recession projection rather than keeping rates normal, 5%. So let's go back to that. It's an interesting point. I can find it. Yeah, here we go. So these are the projections. Let me share with you. Here we go. Maximize that. Yeah, these are the projections. And what you're talking about is the policy rate, I guess. So the projection is, let's look at the dots actually, because that's kind of clearer, isn't it? Dots, dots, dots. Here we go. So what the dots are telling you is that they think inflation is going to be under control by 2025. So if we look at their projection for the PCE inflation, you can see by 2025 it's very close to their 2% target. There are some people who think it'll be higher, but not many. And so if it is under control, then they can start to lower rates with a lag, of course, because they want to really be sure that inflation's under control. The last thing they want is for a secondary spike in inflation, and then they have to raise policy rates again and create huge uncertainty. So they'll err on the side of stamping out inflation by keeping rates higher, maybe higher for longer than you'd expect. And given that growth is kind of okay and unemployment hasn't spiked, they're more likely to be able to do that without hurting the economy, now that the soft landing's looking like more likely. So if we look at the dots again, the reason why the rates are coming down at this point in 2025 and 26 is because they've got inflation under control. And if we look at their forecast, you can see the distribution of their projections for GDP, for unemployment, and the one I want is inflation. Yeah, here we go. So currently for this year, they're forecasting inflation to be around between 3.1 and 3.4% with a kind of upper tail up to 3.8. Next year, centered around 2.3 to 2.6. And 2025, some people think it's going to be between 1.9 and 2, but the central point, the mode, seems to be 2.1 to 2.2. So that's why in 2025 they can start to lower rates, and then by 2026 things look normal. And of course, longer run, they think it'll be at the target rate. So it's not really a forecast about, or how did you put it? Let's just see your comment again. Yeah, it's not really a comment about a recession projection, because remember what they're forecasting for growth is actually increased. The inflation growth, their growth expectations have improved relative to their previous summary of economic projections. So that's because growth surprised on the upside, a soft landing has become the central narrative, and So that's now what they think is going to happen. There's going to be weak growth, but no recession, and that's why you get a normalization of their policy rate, because inflation starts to fall and their medicine works. That's what they expect. So not a recession projection, more a matter of going back to normal. And where will normal be? Well, it'll be their long run policy rate, which is 2.5 according to the dot plots. Is it 2.5? Let's go back. The long run is around 2.5. Yeah, that's the median expectation. There we go. So back to your questions. The next question's from Gary, who says, I know you don't make forecasts. Yeah, you're not wrong. Still, can you please share your thoughts on the dollar index and EM equity going forward? So let's have a look at the dollar index, and we can use Koifin for that. DXY. Here we go. Dixie. There we go. Yeah. Share my screen. So this is Dixie according to, which is like a trade weighted dollar index. And I can go out further. So yeah, there has been a strengthening of the dollar over the course of the last year or so, then a weakening, but generally it's a trend of strengthening since 2012. That's the kind of broad picture. If we zoom in, recently it's been getting stronger, but your question is about what's going to happen to the dollar. So what's driving it for starters? Well, interest rate differentials are the most important thing. So if Fed rates are higher than everybody else, that pushes the dollar higher, it makes it stronger. Now it's the case that other central banks are catching up with the dollar and the policy rates of the Fed. So that interest rate differential is getting smaller, and that means that the driver of currency, the primary driver, which is policy differential, which is rate differentials, that's getting smaller. So what I'd expect now is for the dollar to stabilize now that other central banks have kind of caught up. The Bank of England, for example, has a policy rate which is very similar to that of the Fed. So if we look at rates, again, we can get these from Koifin. Look at the global yields, and if we look across the yield matrix, you can actually compare. Let's make it a bit bigger. The US, the 10-year part of the curve, for example, the US is at 4.4, Canada's at 4, UK is at 4.2, Germany's lower, of course, France is lower, Italy's comparable, and Japan is way off, right? Okay, but they haven't really done much to do to increase policy rates, and they still have yield curve control at the 10-year point anyway. Australia 4.3, and then we have EM. But generally across most of the developed world, except for Germany and some of Europe, some European countries, the yield is comparable with the US now. So that driver of interest rates has now kind of weakened. So that's why I think now we're going to have a period when it's kind of stable, Dixie, the dollar index. But then what's going to happen, presumably, is the Fed will beat inflation before everybody else. It kind of has already. You can see how far ahead it is in terms of inflation. That graph that we saw earlier comparing UK and US inflation really makes that clear. Let's just see that again quickly. Yeah, where was it? Here. So you can see that the UK is way above, and so is Europe, way above where the US is. So if anything, the US has kind of licked inflation already, roughly, and they're just making sure that it stays low. But what's more likely to happen now is that they'll come out of this rate tightening cycle before everybody else. So rates in the US will then fall before everybody else does, and then presumably the dollar weakening will happen because interest rates in the US will be lower than elsewhere. So that's probably what's going to happen. I don't make forecasts, but what I would expect is that the dollar would weaken when that happens. So we'll just have to wait and see what happens to growth as well. The US growth has been pretty strong. Growth is another thing which makes a currency strengthen, and US growth has been better than that in Europe, better than in the UK certainly, which tends to make the dollar strengthen. But yeah, once the Fed starts to lower rates, then I'd expect to see some kind of dollar weakening. But if we do get a kind of risk-off move, then yeah, the dollar will strengthen again because it is a safe haven currency. That's still the case, and that'll remain the case pretty much forever, I suspect. Anyway, back to your questions, and that's it for the members. I'll answer a few questions from everyone else. So yeah, I mean, if you do enjoy these kind of summaries of economic policy and monetary policy, I will be doing one for the Bank of England tomorrow. So if you're a Brit, you know, tune in for that. I'm not such a big fan of Andrew Bailey, but that'll probably come across. Let's have a quick look at your questions. Someone's calling me Nima. Interesting. There is a Nima Nakisa who used to be the goalie for Iran, their football team. Maybe that's what you're thinking of. Sunboy says, could we experience a crash in the S&P 500 at a level similar to the 2008 financial crisis? Yeah, it's going to happen at some point. You don't know when it's going to happen. But look, you can't allocate your capital on the basis of stock indices potentially crashing. It's kind of like saying, look, I won't walk out onto the street in case I get run over, or I won't get in my car, or I won't eat bananas because they'll give me radiation. You know, I mean, it's kind of like some of these risks are just ridiculously low. And I think a 50% fall in the S&P is quite unlikely. The probability of a 30% or higher fall in the S&P in any given 12-month period is about 2%. So very low probability. And look, even if it does happen, unless you're kind of already retired, you're probably still going to be drip feeding at those low prices and getting better returns as a result. So, you know, I really wouldn't panic about that happening. Oh, McCready747, hello. Had an exchange on Twitter with you earlier. Pleasant one, obviously. Generic Penguin says, take a drink. I think that's when I was choking. That's what caused it. Anyone else? Just see if there are any other questions from members. No. Royal London Money Market Fund is giving around 6%. Actually, that was one of the ones I looked at on Slack. Let me just pull up the graph, actually. See if I can find it. Yeah, here we go. I'll make it bigger, yeah. So I can show you this on... I'll make that bigger. Yeah. Let me just share this with you. So this is something I shared with members. I occasionally update this graph, but what you can see here is for 6 of the UK accumulation money market funds, the SONIA rate is in yellow, and the blue line is their current 22-day return annualized. And what you can see is that they're pretty closely tracking SONIA, the Sterling Overnight Index average. So yeah, that's at 5.2. Currently, this BlackRock Cash D fund is giving you 5.7. This BlackRock one is giving you 5.2. CSH2, which is the one I've got, that's giving you 5.4. 6.2 from this Legal and General one. Royal London's giving you 6.8. and there's Vanguard one, which you can't buy. It's the accumulation version, which is for institutional investors. That's giving you 5.7. The income version pays an income, so there's going to be a lag before it picks up higher rates, but still, that should give you roughly the same as the accumulation fund. So that's the kind of snapshot a few days ago of what you were getting with UK money market funds, which is pretty attractive and requires zero work, which is always a bonus. Now, of course, it's still negative in real terms because inflation is still above 6%, but still a pretty good return for a very low risk investment, which is great. Back to your questions. I'll answer a couple more, then we'll finish. McCready747 says, "Oh dear, Bank of England." Yeah, quite. Dr. Scopify says, "Do you think US Treasury yields are at a peak or have more room to rise?" Well, certainly at the short end, if you look at what the FOMC members were saying, they're saying that, yeah, they could probably have another hike before the end of the year. And we've got 2 more meetings to go. And about 7 FOMC members out of 19 thought there'd be another hike. So yeah, there's a fair chance that they will go higher at the short end of the curve. And that would push up the short end of the Treasury curve as well. So I'm sure the Treasury yield curve has already reacted to that today. If we look at US 1-year yields, yeah, they did tick up a bit today. Let me just share that with you. So again, this is on Coifin. If you look at the 1-year yield in the US, it did tick up a little bit today, closed at 5.496, which is a little bit higher than yesterday. Maybe that, I think that was probably when markets were open. So yeah, 23rd, the 20th, yeah, the 20th, so that was today's close, I guess. So yeah, a bit higher. And I think they probably will go higher at the short end. How are we doing? Okay, I think we'll probably draw it to a close there. Don't forget, tomorrow I'll be back again in this room, probably in this shirt and choking on my Fanta again. And Teddy will be having more treats. Maybe we'll give him biltong tomorrow for the Bank of England as a special treat, in praise or as a homage to Andrew Bailey's Greg's Habit. So yeah, let's join each other again tomorrow for another live stream. Thank you all for joining us this evening. I hope it was helpful, and yeah, I hope you all have good luck with your portfolios. Take care, everyone. And if you ask a question, thank you. I'm sorry I couldn't answer everyone's question, but take care, everyone, and see you tomorrow evening.